There is nothing more straightforward than dollar cost averaging in terms of investing and making money. This strategy needs minimal investment expertise, luck, and decision-making aptitude, but offers investors endless possibilities. It lowers the danger and aids in maximization of revenues over the long run. Using this method, which is quite straightforward, is a great idea all around. Learn at how to become a multi-billionaire on autopilot through dollar cost averaging and how you might use this technique for your own situation. Let us examine exactly where you must invest your money to get good returns without doing anything, typically returning 10% or more a year. Welcome to the Rise and Grind YouTube channel, where we share our knowledge in personal finance, investing, and other related topics. If you'd like to see more videos like this in the future, please subscribe to the channel and give this video a thumbs up if you found it useful. An investment strategy known as dollar cost averaging involves investing a specific sum of funds on a constant schedule, weekly, monthly, or even daily, regardless of market volatility. Let's imagine you start investing $500 into an ETF with a share price of $100. The value of this investment changes from day to day, just like any other. Your initial investment of $500 buys you 5 ETF shares in the first month. Market volatility means that ETF's price could rise to $80 per share during the next month. That's 6.25% return on your investment of $500. Now, in month 3, the ETF has rebounded and increases to $120, so $500 only buys 4.16 shares. If EFT's prices rises, your $500 will buy fewer shares. However, if the market falls, your $500 will buy a lot more. You don't have to worry about deciding how many shares to acquire because it's done for you over the course of time. To put it another way, if you had acquired all of your shares at lower price, this method may cut your average price per share. The fact that you may automate the process of dollar cost averaging by establishing a regular payment to your investment account is one of the most significant advantages of using this strategy. In the event that your workplace has a 401k plan, you can have this deducted from your paycheck and put it straight into your account. You have an option of transferring funds to an IRA directly from your checking or savings account. The benefit of investing automatically is that you are more inclined to do it on a weekly, monthly, or another regular basis. The likelihood that you won't invest is substantially higher if there is no automated payment. Think about what it will be like when you receive a paycheck every 2 weeks. Consider whether or not you should invest this week, as well as how much you would put aside for bills and other obligations before making a decision. Isn't it fine to skip a week? It is hard to imagine a more enjoyable way to spend your money than on a night out on a town. Your retirement will not be affected. Skipping this step, on the other hand, might develop into a bad habit that is harder and harder to break. To invest continuously and without interruption, automate the process by determining when and how much to invest beforehand. Additionally, when the funds are routinely transferred to your investment account, you are much less likely to discover that they have been removed from your savings account or salary. When you make frequent investment, you don't have to think about getting the incorrect stock at a bad time. With a lump sum investment, you run the danger of investing just when the market is about to see significant decline. Imagine if you had invested all your savings in 2007, shortly before the beginning of the global recession. Dollar cost averaging and smaller investment over time would have resulted in far less money being lost. Before things were bad, you'd have started investing in the stock market with a tiny amount. Then you would have keep investing smaller amounts when the market improved. If you don't get in early enough in a bull market, you could miss out on a great opportunity to get on the ground floor. Suppose you have an extra $1 million to invest but aren't sure how to proceed. If you have $1 million to invest, would you invest everything at once or spread it out over the course of the next 12 months? Your time in the market will extend if you decide to put all of your money into stock market at the same time. So rather than throwing all your eggs in one basket, scatter them out over time by making small but consistent investment over the long term. If you have $1 million to invest right away and spread the money out over 12 months, you'll likely get better returns than if you wait a year and spread it out over a year. The dollar cost averaging technique loses the immediate returns on the $1 million worth of investment 75% of the time over the course of 10 years. Despite the fact that this is merely a broad illustration, the answer to the question of which one is superior ultimately depends on the behavior of the market in the future. Naturally, if you could predict the future and saw the market was going up continuously with no recessions, the wisest bet you could make would be instantly invest all that you have. You're hoping that the market doesn't take tumble short after you invest, since that would eat into your $1 million investment. Investments made over a long period of time have historically performed than those made over a short period of time. Sadly, most people lack the financial resources to invest in the stock market. In lieu of this, people can set away a modest portion of every salary, dollar cost average into the market, and reap the rewards of that technique. Investing consistently over a long period of time is the best way for a typical person to grow riches. In good times, when the market is flourishing, and in bad, when it is plummeting, this involves making investment in stocks. Dollar cost averaging is a great approach to generating wealth because of the absence of decision making and the stress you'll experience. Automating your investments, payments, and forgetting about them is the way to become a great investor. When the market declines, you won't freak out as a lot other people do. Due to their anxiety and doubts, they either quit contributing or decide to sell everything they own. While you keep investing in the market even when it's falling, you position yourself to take advantage of buying chances throughout the entire market cycle by making purchases when the market is falling at its lowest point. Your chances of making significant earnings will skyrocket as you climb back to the top of the chart. If you put your money in the right places, you can earn above average return that will grow your account to the point where you can retire comfortably. Options range from actively trading mutual funds to choosing individual stocks and purchasing cryptocurrencies, among others. Although in certain cases, the simplest option are the most effective, there are numerous advantages to investing in the S&P 500 index. S&P 500 funds are accessible to a wide range of investors. There are a variety of low-cost options available, like Vanguard and Fidelity Investments, which charge exceptionally low fees for the ownership of these funds. Investing in the index entitles you 500 shares in the most lucrative U.S. corporations, spanning a wide range from technology to everyday necessities. Even if your exposure to different sectors fluctuates, you'll still have a wide range of industries to choose from. The index also eliminates companies that are no longer valuable. Simply put, you're making low to no risk investments in huge, prosperous U.S. corporations across a multitude of sectors. With an average yearly return of 10.5% since 1957, the S&P 500 can provide you with good returns. No wonder Warren Buffett promotes this index to the most investors. Dollar cost averaging is not necessarily the best strategy for long-term wealth accumulation. It would be ideal to put away a substantial sum of money for retirement when one is young. But this is not a possibility for majority of us. Fortunately, this technique has several advantages that can support the typical individual in accumulating enormous riches. Once the technique has been established, no additional time or effort is required. You do not need to keep a close eye on your investment portfolio each and every day, getting worked up over ups and downs over the market while simultaneously pondering what course of action you ought to take next. Investing success can be achieved by automating the process and eliminating the need for human judgment. We sincerely hope that you enjoyed watching this video. Subscribe to our YouTube channel for more videos about cryptocurrency and finance, and show us your appreciation by giving a thumbs up and by leaving a comment below. Thank you for tuning in, and we'll see you again soon.